You've been running around the internet wondering how DSCR loans work for Airbnb. I don't care if you're getting into your first one or you've already got 10 under the belt, you are not going to want to miss this video. Now, DSCR loans for Airbnb, what lenders actually look at before funding a short-term rental. If you're scaling a short-term rental portfolio, understanding how DSCR loans work and what lenders actually evaluate is the difference between hitting a wall at property 2 and building a portfolio of 10. This guide breaks down the ratio, the income math, the credit requirements, and the 5 tool stack that keeps investors moving deal to deal without draining their personal savings, like a revolving war chest. What a DSCR loan actually is. DSCR stands for Debt Service Coverage Ratio. Unlike conventional financing, a DSCR loan underwrites the property itself, specifically whether the rental income generated by that property is sufficient to cover the mortgage payment. So there are no personal tax returns to pull, no W-2s to submit, and no personal debt to income reviews standing between you and the next deal. This distinction is what makes DSCR loans so powerful for portfolio investors. Property number 10 doesn't get harder to finance just because your personal DTI is maxed out from the first 9. The loan lives and dies on the property's income performance, not your personal financial picture. So we're talking property-based underwriting. Lenders evaluate whether the rental income covers the mortgage, not your personal income or employment history. No personal financials, no tax returns, no W-2s, and no personal debt to income ratio review, standing in the way of approval and scaling beyond your income capacity. Scales with your portfolio. Each property is evaluated independently, so adding more doors doesn't compound your personal qualification burden. So here's the DSCR ratio lenders want to see. Most lenders require a minimum DSCR of 1 to 1.25 to approve a short-term rental loan. So a ratio of 1 means the property's rental income exactly covers the mortgage. A ratio of 1.25 signals a comfortable cushion. Lenders reward that with better pricing and more favorable terms. So the higher your ratio, the more leverage you have at the negotiating table. For properties that fall below 1, some lenders offer no ratio programs. These products exist specifically for deals where income doesn't fully cover the debt service, but they come at a cost and they're very rare. So expect a larger required down payment and a higher interest rate in exchange for the lender absorbing that additional risk. So below a 1, those are the no ratio programs, higher rate, larger down payment required. A 1 to 1.25, this is your standard rate and meets minimum requirements for most DSCR. And then above that is a strong ratio, earns better pricing, lower rates, and more favorable loan terms. So how short-term rental income gets calculated? Lenders don't take your word for what a property will earn. They rely on one of these 3 sources to determine qualifying income. A projected income report from AirDNA, an actual trailing 12-month booking history from the property, or a rent schedule with an STR adjustment applied by the lender. Each method has its own strengths depending on whether the property is already operating or being acquired. So regardless of which income source is used, expect a 10 to 25% discount applied to the gross STR income figure. This haircut accounts for seasonality, vacancy risk, and broader market uncertainty. Lenders are underwriting to a conservative, sustainable number, not your peak summer weekend rate. Don't underwrite to your best month. The lender won't, so take that into account. The 3 income sources summed up: AirDNA projected income, trailing 12-month booking history if you're already in there, or rent schedule with STR adjustment. The income discount, 10 to 25% haircut to account for the risk and the seasonality. So make sure you're underwriting conservatively. So credit score and down payment requirements. Minimum credit scores for DSCR loans typically start at 620 to 660, depending on the lender, with better pricing unlocked at higher score tiers. While the loan qualifies off the property, your credit score still influences the rate you receive. So keeping your personal credit clean remains a meaningful lever for investors. Down payments on DSCR loans typically run 20 to 25%, with some programs as low as 15%, depending on the ratio and the pricing the borrower is willing to accept. Now, short-term rentals often carry a higher down payment requirement than long-term rentals. Some lenders require 25 to 30% on SDR versus 20% on LTR. Maximum loan to value is typically capped around 75 to 80%. So take all of this into account to know where your gap is. And that's what we're going to get into next. How do you cover that gap consistently? So before we get there, why this matters for scaling. The structural advantage of DSCR financing becomes clearest when you zoom out and look at what it means for your portfolio growth. There are no personal tax returns, no W-2 requirements, and no personal DTI ceiling, capping how many properties you can hold. So the loan grows with the portfolio income, and the business itself sustains itself in terms of how quickly you can grow, not with a personal paycheck. That's a fundamentally different model than conventional financing, and why it's investors holding more than one or two short-term rentals almost always end up on a DSCR instead of conventional products. Now, the reason investors holding more than one or two STRs almost always end up on DSCR instead of a conventional mortgage, it's simple. The loan grows with the portfolio income, not a personal paycheck. So that's all summarized at the bottom here. And this is the 5-tool stack that keeps you scaling. Here at Gap Funded, we've got a specific method to make sure you're never pulling any savings out of your back pocket, and you can continuously to scale with different products and lines of credit to become your own bank as you go. So the DSCR loan covers the mortgage, not the down payment, closing costs, or furnishing. That gap is real money, especially when moving from deal 3 to deal 4 to deal 5 back to back. The 5-tool stack fills everything the DSCR loan doesn't cover, and none of it requires draining personal savings. So obviously you can get into a deal if you've got to do some fix-ups before it's ready for Airbnb. You can use hard money for that rehab and based on the after rehab value to get you in, and it bridges the purchase before the DSCR refinance is in place based on once you've got your first few tenants coming through, then you can obviously refinance into a DSCR. Gap funding, term loan stacking, covers the shortfall between what you have and what you need to close. It's purpose built for the gap. DSCR doesn't fill. This lands in 1 to 3 days. It's rapid. It's unsecured against your own personal credit profile. So it's very straightforward and prepares you for 0% credit card stacking. If you can use some of that gap funding to also pay down credit card utilization, if you've got that high, you're going to prepare yourself with a much better FICO, better terms, better rates, and even for the primary loans as well, like hard money and DSCR. Now, your 0% credit card stacking, we're taking 4 to 5 business cards, stacking them together. On the first run, you could expect up to 150 grand. This furnishes the property without touching savings, leverages intro rate periods to deploy capital interest-free, and as you pay those down responsibly, you can go and ask for limit increases and be ready for another larger stack at the end of the intro 12 to 18 months. Now you've got a HELOC. This taps into equity already built into another property. So that could be a home or an LLC based or an LLC owned investment property, and it turns existing assets into fuel for your next acquisition, like a massive credit card backed by the equity in a property. So it's like you becoming your own bank. You've got this line of credit. You could maybe use 20 grand on that first STR, you got another bit left over. And then as soon as you pay those down from the rents, it's revolving. You can use it again and again without additional closing costs or negotiation. A business line of credit, it's revolving cash for the next deal's down payment while waiting on this one's DSCR refinance to close. Now, because STR has a fairly consistent income, business line of credits will become available as you're starting to put about 20K consistently per month through the till. The system, DSCR loan for long-term financing, the 5 tools for everything the DSCR loan doesn't cover. None of it requires draining personal savings. Now, here's the next steps. DSCR loans qualify off the property. That's the backbone of scaling a short-term rental portfolio beyond what conventional financing allows. Pair the DSCR loan with a 5-tool stack to cover the down payment, the gap, and the furnishing, and you have a repeatable system for moving from deal to deal without hitting a personal finance ceiling. Explore the kit. Every link you need is in our toolkit, a Gap Fund kit, and then apply for a free strategy session. Jump on a call with me, see where you're at or the steps you need to take to actually position yourself for these strategies. Worst case scenario, you walk away with a game plan and those steps you do need to take, and subscribe for more. Get ongoing insights on DSCR loans, gap funding, and scaling short-term rentals without savings. I'm Mick Wadley. Let's go close something.